Today, we will talk about the loan-to-value (LTV) ratio. The loan-to-value ratio is an assessment of lending risk that financial institutions and other lenders examine before approving a mortgage. Typically, loan assessments with high LTV ratios are considered higher-risk loans. Therefore, if the mortgage is approved, the loan has a higher interest rate. Additionally, a loan with a high LTV ratio may require the borrower to purchase mortgage insurance to offset the risk to the lender. This type of insurance is called private mortgage insurance, PMI. Interested home buyers can easily calculate the LTV ratio of a home using a simple formula. An LTV ratio is calculated by dividing the amount borrowed by the appraised value of the property, expressed as a percentage. For example, if you buy a home appraised at $100,000 for its appraised value, and make a $10,000 down payment, you will borrow $90,000. This results in an LTV ratio of 90%. Determining an LTV ratio is a critical component of mortgage underwriting. Lenders assess the LTV ratio to determine the level of exposure to risk they take on when underwriting a mortgage. A higher LTV ratio does not exclude borrowers from being approved for a mortgage, although the interest on the loan may rise as the LTV ratio increases. In general, the lower the LTV ratio, the greater the chance that the loan will be approved and the lower the interest rate is likely to be. An LTV ratio is only one factor in determining eligibility for securing a mortgage, a home equity loan, or a line of credit. Most lenders offer mortgage and home equity applicants the lowest possible interest rate when their LTV ratio is at or below 80%. A higher LTV ratio does not exclude borrowers from being approved for a mortgage, although the interest on the loan may rise as the LTV ratio increases. For example, if you buy a home that appraises for $100,000 and if you make a $10,000 down payment, your loan is for $90,000, which results in an LTV ratio of 90%. If you were to increase the amount of your down payment to $15,000, your mortgage loan is now $75,000. This would make your LTV ratio 75%, i.e., 75,000/100,000. FHA loans are mortgages designed for low to moderate income borrowers. FHA loans allow an initial LTV ratio of up to 96.5%, but they require a mortgage insurance premium that lasts for as long as you have that loan, no matter how low the LTV ratio eventually goes. Many people decide to refinance their FHA loans once their LTV ratio reaches 80% in order to eliminate the MIP requirement. VA and USDA loans, available to current and former military or those in rural areas, do not require private mortgage insurance even though the LTV ratio can be as high as 100%. However, both VA and USDA loans do have additional fees. Fannie Mae's HomeReady and Freddie Mac's Home Possible mortgage programs for low-income borrowers allow an LTV ratio of 97%, but they require mortgage insurance until the ratio falls to 80%. For FHA, VA, and USDA loans, there are streamlined refinancing options available that waive appraisal requirements so the home's LTV ratio doesn't affect the loan. While the LTV ratio looks at the impact of a single mortgage loan when purchasing a property, the combined loan-to-value ratio is the ratio of all secured loans on a property to the value of a property. Lenders use the CLTV ratio to determine a prospective home buyer's risk of default when more than one loan is used. Let's look a little closer at the difference. The LTV ratio only considers the primary mortgage balance on a home. Therefore, if the primary mortgage balance is $100,000 and the home value is $200,000, LTV equals 50%. Consider, however, the example if it also has a second mortgage in the amount of $30,000 and a HELOC of $20,000. The combined loan-to-value now becomes $100,000 plus $30,000 plus $20,000/$200,000 equals 75%, a much higher ratio. Most lenders use 80% as the threshold for a good loan-to-value ratio. Anything below this value is even better. Borrowing costs can become higher, or borrowers may be denied loans, as the LTV ratio rises above 80%. The main drawback of the information that a LTV provides is that it only includes the primary mortgage that a homeowner owes and does not include in its calculations other obligations of the borrower, such as a second mortgage or home equity loan. A 70% loan-to-value (LTV) ratio indicates that the amount borrowed is equal to 70% of the value of the asset. In the case of a mortgage, it would mean that the borrower has come up with a 30% down payment and is financing the rest. For instance, a $500,000 property with a 70% LTV would have a $150,000 down payment and a $350,000 mortgage. Loan-to-value is calculated simply by taking the loan amount and dividing it by the value of the asset or collateral being borrowed against. In the case of a mortgage, this would be the mortgage amount divided by the property's value. Here are 5 key takeaways. 1. Loan-to-value (LTV) is an often used ratio in mortgage lending to determine the amount necessary to put in a down payment and whether a lender will extend credit to a borrower. 2. Lower LTVs are better in the eyes of lenders, but require borrowers to come up with larger down payments. 3. Most lenders offer mortgage and home equity applicants the lowest possible interest rate when the loan-to-value ratio is at or below 80%. 4. Mortgages become more expensive for borrowers with higher LTVs. 5. Fannie Mae's Home Ready and Freddie Mac's Home Possible mortgage programs for low-income borrowers allow an LTV ratio of 97%, 3% down payment, but require mortgage insurance, PMI, until the ratio falls to 80%. Hope this would help. Thanks for watching.